the key, even more important piece of DePIN is actually the ability to participate in the growth and success of the network in a way you cannot in the traditional centralized sharing economy. You can participate early on and then participate in the upside as that network grows in a way that's impossible in the traditional centralized world because those companies cannot give equity to people. Fluence, our providers for proof of compute, are paid in our token, but it's targeting $10 per core per month. And so token price changes, the amount of tokens they get changes, but we're still targeting that particular fiat amount. That's designed to provide a stable revenue for those providers.
Tom, welcome to the Building in Public podcast. I know you have a podcast of your own called DePINEd, which is really, really great. So it's probably funny for you to be on the other side of the seat here recording with me. But I wanted to have you on to talk about what you're building at Fluence a bit, which I think people do know about, and then also mostly about your pretty detailed report on DePIN Tokenomics that you put out recently. So maybe let's start with your podcast, though. You're about 50 episodes in now. What was the motivation behind starting that, and what have you seen as like the benefits to you or Fluence so far?
Well, listen, first, thanks for having me on. Love to be here. And I just think it's great to collaborate on all these things, right? You guys have a great podcast, and I think you guys, so you guys are doing it before me, other people are doing it before me. And so I just think we need these outlets to get as much airtime and traction for the DePIN ecosystem that we can. So, thrilled, and I'm sure guests I've had on, you've had on, and vice versa. And there's probably a bunch of overlap, but I'll tell you that I'm sure the same guest on you and first me, we pull other things out of it. So there's a lot to talk about here, and so I'm thrilled that there's multiple people pursuing this. And to answer your point, I was actually at ETH Denver last year when we did the Fluence launch, and I was talking to a friend of mine who had recorded some podcast episodes. I was sort of thinking about what to do. I'm like, you know what? I should do a DePIN one. Like, I want to get a platform to talk about this space more. And, the idea really was to use it as a platform for me and Fluence to get to know other people in the space, and just to serve as kind of a community kind of hub in a way. And so we host our DePIN days as well. And so the real benefit also is the interplay between the two, where DePIN Day is the IRL, the real life. We've hosted 10 DePIN days so far, where people get together and meet and talk in person. And then we get to have them on the podcast. I get to have them on the podcast before or after that. And so that really helps create a link, and I hope some community here as well. And so that's been terrific. And so it establishes a relationship, and then that makes the day go that much easier. And I ended up hosting almost all these things as well. So I got to introduce people and make it all work. So I think that all ends up being pretty synergistic.
100%. Yeah, I really admire how you've taken a pretty differentiated approach to marketing and partnerships and events, and kind of doing it all in-house at Fluence. And I think you're rightly seeing the benefits of all of that. Like, a podcast is a very underrated marketing channel, I think. And then when you layer on the events as well, you definitely build a name brand for yourself pretty quickly as a crypto project. So it's a way to speed run building a network, I think, and also provide yourself with a platform to get your message out there.
It definitely helps get the message out there. I mean, I frankly think the podcast could have more of our message in it. I mentioned Fluence once in some of them, sometimes not at all. So it really depends on what the topic is. But it also, every project has its followers. They're going to pay attention to a podcast, and they get to learn a little bit, or at least understand a little bit about DePIN Day or Fluence. That's a positive as well. But I think, the other point I got to make here is that I'm lucky in that I have two co-founders. And if it was just me at Fluence, I would have zero chance or bandwidth to do something like this, like none. Mm-hmm. And so it really is the benefit of having two other people who are deeply engaged in Fluence. It gives me the opportunity to add this on, which I did not do at Hedera. And you don't see many founders doing either because there just aren't hours in the day.
No, 100%. And speaking of Fluence, let's cover that real quick before we dive into the DePIN report. So I think most of our listeners are probably familiar, but if you could just give a super quick kind of high level about what it is you're building at Fluence, and then, I don't know, maybe a few examples from like the report that you've taken as like best practices that you've implemented in the Fluence, like tokenomics or governance structure, for instance.
Well, listen, first on Fluence, we are a decentralized compute platform. And so that is basically like a cloud-like entity, cloud-like service, but decentralized. We call ourselves cloudless. And so what that means, it's open, it's resilient, and it's lower cost than using centralized clouds. And so it's compute. And the first thing people think about when they hear compute in our space, they think AI, they think GPUs. But we're actually CPU based now, which is the, billions of CPUs that perform 99% of all the computation that happens all over the world on the internet everywhere. So that is where we are most, if not all, decentralized compute is focused on AI training, and that's a great model. It's growing significantly, but compute is just vast right now. And if you look at, Amazon or Microsoft or whatever, Google, the compute those guys do is, hundreds of billions of dollars, right? That's not even getting to the AI stuff yet. So it is just a vast market. And it also is filled with people who are unhappy with the current customers for a variety of reasons. It's hard to leave. It's expensive. The tools are too complex. There's services they don't use. Like, you could list it. So, if I wanted to just big picture, pick a space, what I want to do, what's a good opportunity, pick a huge market that's growing quickly, that has unhappy customers, right? That's what you'd want to do. And so that's now all being said, then you got to build the product that they want, and it's got to be usable and everything else. So it's not like that's all you got to do, but that's what we're doing. And in terms of tokenomics, we spent a lot of time looking at it. Obviously I I helped kind of put together all the token economics and sticking at Hedera as well from the very beginning. I basically joined that when it was a white paper and helped Mans and Lehman found the public ledger. I joined when it was, called Hashgraph. So Hedera didn't even exist at the time. And we spent a lot of time trying to think about this, and we do not have all the answers, and we're still probably going to evolve it to some extent. But I think the main points you got to think about is what you need for security and what you need to create a valuable and enduring token ecosystem, with a view that you must figure out how the token is valuable, or else someone else in your space will, and they will beat you. And so that's sort of the underlying premise, is like, this project has to be designed to make this token valuable, because that's probably where security comes from. And it also is, if you don't, someone else is going to, and they'll beat you. So that is sort of the underlying premise of it all. And for us, the scarcity comes from staking. So as we scale, you have to add stake to every CPU that joins the network, and that stake is denominated in dollars. And so that kind of keeps scaling linearly with the network as it grows. But while stake scales linearly, supply is fixed, right? So, you come across, you hit that, scarcity point at some point. The easier one, I think, is obviously buy burn, and that we can talk about a lot. I think that's better and more easily applicable for the physical DePINs, I think is more the term that Masaru uses, where it's actually collecting data, distributed data from a DePIN network, and then selling it. So there's sort of one point of sale, and lots of different people benefit from that, versus more the marketplace kind of model that the compute and storage providers have, where they're not themselves generating so much revenue. But I may be going into too much detail here, and obviously happy to talk about governance as well.
Yeah, I think that's a great overview, and we'll hit a lot of those points over the next few minutes here. I like the mental model that you just put forth of kind of tokenomics being broken down into two buckets of like creating value in the ecosystem and creating a valuable token, and then also just like defending it, right, through governance and defending both the network and like the economy you created, and also the token and its value. So I think that makes a lot of sense. One idea that you put forth that I liked a lot, that I've done some thinking on myself, is kind of like positioning Uber and Airbnb and other companies like them as the sharing economy kind of 1.0. And that was a pretty revolutionary concept when those companies first came out, right? Where there's consumers receiving a service like ride sharing or a hotel stay, essentially, but it's facilitated by an asset that's not owned by the corporation, right? It's like someone that has free time and they have their own car and they want to drive people around. Do you see DePIN as the sharing economy 2.0? And maybe what kind of key similarities and differences do you see between DePINs and between the Ubers and Airbnbs of the world?
Yeah, listen, I think that the sharing economy is one way to look at it. I think you look at that from that kind of the sharing economy, though, understates the economics involved, I think. And so sharing makes it seem a little separate from remuneration, which is a key part of all of this. And I think that's the key, even more important piece of DePIN is actually the ability to participate in the growth and success of the network in a way you cannot in the traditional centralized sharing economy, or if you look at it from a business side, like the capital light business models, right? Uber doesn't buy cars, Airbnb doesn't buy hotels, it doesn't buy apartments, right? So those companies still use a lot of CapEx. And the interesting part also, just to make another point here, but there's a couple differentiation pieces. I think in your big picture question, yes, it's sharing 2.0. But B, I think it's more than that. It's capital light business model 2.0. And capital light means Uber and Airbnb don't have to buy the physical infrastructure. But the problem with those two businesses, what they do have to do is they have to get consumer adoption and consumer trust. And that takes massive advertising budgets. And they spend a ton on advertising. And they also have a lot of turnover. And so because most DePINs are actually business services, right? If you're doing the Hive Mapper, you're selling to businesses. If you're doing, WingBits, you're selling to businesses. You pick your DePIN, they're almost all business-oriented customers, which means you don't need to spend this advertising amount. So it means your business model requires no CapEx like those guys and also no advertising. And those are two massive, massive advantages. And then the other piece of this, which I referenced early, is that if you're an early participant in these networks, early provider, if you're an early provider at Uber, early provider at Airbnb, you get paid, great, dollars, fine, you're making money. But as the network grows, you probably are just facing more competition. Uber is going to raise the price on you. You're going to have more people competing. Maybe more people know about it, but you're also competing more with the models in the DePIN models. You, as that grows, you may have more people competing with your helium hotspot. But a lot of those models have now figured out how to kind of secure that. But the real benefit is as the network grows, the tokens you receive in the beginning, if things work out well, as architected appropriately, should appreciate in value significantly. And so you can participate early on and then participate in the upside as that network grows in a way that's impossible in the traditional centralized world, because those companies cannot give equity to people. And tokens are not equity, but if the economics are set up appropriately, you can see and should be able to see significant appreciation over years. And now some people will sell right away and they won't participate, and that's totally fine. That's their call. But there's that potential that exists, which is optionality, which is valuable, which is not the case for all these other businesses.
Right. And taking that line of thinking a step further, even if you are giving contributors kind of a stake in the network or the business that's being run, a lot of times you can turn the kind of marketing spend on its head, right? What was it called? Teleport was kind of like a decentralized rideshare startup that sadly closed its doors about 6 months ago. But I always thought the concept was really interesting, and they put forth this idea of permissionless marketing, which was basically the idea that if you pay contributors some of the native token, maybe not all of it, maybe there's some kind of stablecoin component, then they have upside in the network they're building, and they're willing to market their services. So you can think of the example of like an Uber driver also drives for Lyft, but they might be most inclined to take rides on Teleport, for instance, or convince people that are riding in their car to join Teleport as a passenger because they have some of the native token, they have upside in this network, whereas they own no Uber stock, no Lyft stock unless they bought it themselves. So yeah, it can change the economics for these businesses a good bit for sure. How do you think about contributors being paid in stablecoins versus native tokens versus a mix? Because we've seen mostly native tokens in DePIN, but there are some notable examples like Spexy, for instance, that pay in stablecoins.
Well, by the way, what's kind of fun is having the conversation with you where we can bat around all these ideas and knowledge because we each know so many of these projects, and that's kind of a fun thing to do. But I guess what I'd say is that I think that it again, I want to separate the digital. Maybe I don't know if we separate the digital from the from the physical, but I guess what I'd say is that I'm fine either way, but what I think is important is that payment is denominated in fiat, right? And so I think this is how Fluence does it. I think it's how Spexy does it, or will do it as well, which is they get paid. Spexy right now, they haven't launched their token, right? So they're just paying in fiat or credits or whatever. But once they go, I think they will still target a dollar amount that may be delivered in their tokens. And so for Fluence, our providers, for proof of compute are paid in our token, but it's targeting $10 per core per month. And so token price changes, the amount of tokens they get changes, but we're still targeting that particular fiat amount. And that is designed to give a stable, predictable revenue share, or not revenue share, but stable. Let me get my focus here. That's designed to provide a stable revenue for those providers.
I think pricing the demand side in fiat and accepting fiat for it makes a ton of sense. And if you're doing that, you definitely need to pay contributors in fiat as well. Like I've run a couple different mining operations in DePIN, including one that was venture backed, and we were buying a ton of hardware and really spending a lot of money on both CapEx and OpEx. And the contributor costs are priced in dollars at the end of the day, right? It's like electricity and rent for rooftops. And so having contributors be paid in kind of fiat denominated way, like still the native token potentially, but it's like a set dollar amount, I think makes a lot of sense. And you also are way more conservative with your token supply that way too. And you still give contributors upside, right? Like if I'm early to the project, maybe I can make more in dollars because there's like an early bonus. But if I hold on to those tokens, I still have, early access kind of upside that early Helium miners, for instance, got, but they just got like, way too many native tokens and they were just like way overpaid. So I think pricing both supply and demand side in fiat makes a lot of sense. What about staking also? Do you think staking rewards should be priced in fiat?
Well, for us, that's the same thing. And so for us, that $10 per core is effectively staking related. It's staking the reward is split. That $10 per core per month is split between the actual compute owner and the staker. And so effectively the staker is receiving around 20% of that, but in FLT, it's still targeting that same amount. And so it ends up doing the same thing. Now that is and here's the thing, is that it's hard to separate those two things because you're paying for a service. Some of that's going to go to the providers, these fiat costs, and loves it. And some is going to go to the crypto staker who is probably more accustomed to getting some crypto denominated APY. And so the crypto APY now here goes all over the map based on the volatility token. Mm-hmm. And so that is a challenge, and that is certainly complex, right? Because the token price falls. If you're looking at it from a token APY perspective, now your token APY has gone up a lot, right? Because now you're going to get a ton more tokens because the price has fallen and you're getting more. If token price goes up, now you're getting fewer tokens. Your token related APY goes down. So it kind of has, and yet your value is still, from a dollar perspective, your value is still consistent. That model isn't widely done in the crypto universe. And so we are early with Fluence and we will see kind of how that works. My bet is that institutions are going to like that a lot. and it's the retail may not like it as much.
Yeah, that makes sense. One thing I've been thinking about and have had some discussions with some other DePIN folks about that. I don't know if I saw it mentioned in your report, but I wanted to ask you about is like if native tokens are kind of equity-like, then should token supply be capped or uncapped? I think you all's is capped. That's definitely been the traditional way to do it in DePIN so far. It definitely probably provides investors with more peace of mind and more concreteness around, total supply being a billion or just a fixed number. But in the traditional kind of TradFi world, publicly traded companies can always issue more equity, right? And maybe there's like governance and board voting that could allow that or not allow that, but there is an option to issue more equity. So I'm curious how you think about native token supply caps versus having them be uncapped.
I guess what I would say to that is that I'm a huge fan of supply cap because it makes the goals and the end post pretty clear. And if you don't have the cap, then you create another dimension of problem that needs to be solved from a token economic perspective. You can still get to deflation, but you've just made your road longer and harder. But I think what's super important is your point on dilution. I was actually trying to Google it right now, but if you Google Twitter equity dilution since the IPO, it's something like 30% of additional shares were created effectively post IPO, like a third diluted, some massive number like that. And so when you take the IPO, you're like, okay, great. This is the cap table. This is the structure. Here we go. And yet you continually get diluted down the road. And the knock on crypto is, well, gee, is circulating supply the real number? Is it fully diluted? Blah, blah, blah. And you can go back and forth. But I think the benefit is to say that we are not subject to that endless dilution the way it happens traditionally in technology companies. And if we did, it'd put us on par with them. But then we have a whole bunch of other kind of things to solve. Like we don't give dividends, we don't have cash flows, right? Like it's not like an equity ownership instrument. And so I think there have to be trade-offs for that. And I think a fixed supply is a real benefit. I've heard, I know it was Aki made the case that they think supply issuance and demand should offset each other and that should be sufficient. And I'm not convinced of that. I think that, if they said, we just want to keep adding decimal places. I'm like, well, if you have to keep adding decimal places, you're in a pretty good spot. And I guarantee you, your investors are going to be pretty happy that you're adding decimal places. Your project's going pretty well. So in terms of problems I'm worried about, adding a decimal place is very low on the list.
Yeah, I mean, I've heard people argue that it gives the core team or maybe the community that's governing the network more flexibility, but it also kind of creates this leaky bucket situation where you're like trying to create a lot of value and kind of a two-sided economy within the bucket, for instance, and then you kind of poke a hole in it and some of the water, the value can start to leak out. I also think just given the lack of or like the far lower amount of regulation in crypto versus like the traditional equities markets, like having a capped token supply is more necessary because I think there's just less regulation and kind of trust for like the core teams in crypto because they're a lot smaller and they're startups versus like publicly traded companies where there are just more scrutiny and more laws and regulations around what those teams are doing.
Yeah, I mean, that actually is the best point, which is, and I was talking to a team just the other night about this, where they're designing their tokenomics. I'm like, okay, you got to think about this from the perspective of someone who has been screwed before, and he's just going to assume you're finding ways to screw him, right? And so that everything has to go through that lens of how am I going to be screwed by this project or this team, or what are they doing? And you may be honest and not thinking about it that way, but if you don't come with that lens, you're going to make mistakes because they're going to assume stuff. And so to your point, the fixed supply just takes one of those big concerns off the table for the jaded a crypto investor, of whom, most of us are at this point. And if we're not, we're going to be there soon.
Definitely. The last thing I want to cover is token value accrual, specifically just what methods you've seen work very well in DePIN. I think buy and burn is one you mentioned pretty heavily in the report. And then also maybe any best-in-class DePINs you've seen in terms of both generating revenue, but also accruing it to their native tokens and doing so in a public way.
Listen, I guess what I'd say is that buy burn is the best way I've seen how to do that. The key, and I also add, and I had this conversation as well, is that any amount of daylight between 100% of revenue, buy burn, and zero, anything that is less than 100 starts introducing, either reduces trust or misaligns things. Now, if it's 80%, that's not a lot of misalignment, but there might be some, right? If it's 80% difference, well, now trust and alignment is very different, right? Because now management is taking 80% of the revenue to do something else with it besides a token. And I think, back to an earlier point, you as a token holder, that hat on, you want to be as aligned with that team as possible. And you want them to own tokens and to fully participate in the appreciation of tokens. Now, we all know that right now in this world, the market swings everything. And so the pushback on my point is, well, gee, great, that sounds great, but if I'm buying all this stuff and the market's down 30%, my token's down 30%, who cares? I've just burned revenue for nothing. And I guess the answer I have there is that you could move into that over some period of time, but scale as you're generating real revenue. And most DePIN projects are not generating enough revenue for this to really matter. But you look at, a GeoNet that's at 3 or 4 million right now, and you look at a couple others that are generating in that level of revenue. When you get the revenue at some scale, I think we will see this work. I think right now you've also seen projects say, hey, listen, we haven't seen buy burn work. And to be clear, there's a couple of exchanges that have it and some DeFi projects that have it. I say those tokens have gone down. Well, of course they can still go down, but we also know how much more they would have gone down without buy and burn. And so I think they probably outperformed the average market versus an average, market cap weighted token given it. So I think we haven't yet seen the power of this kick in. And once we see revenue at scale kicking in, if GeoNet's generating $10, $15 million of revenue, I think, and that's 10 to 15 million of revenue that's buying and burning their token and doing it in a super transparent way, on-chain visible. That to me is super powerful because in a world of 32, 34 million tokens, the appetite for new people to go find new tokens and the crowded noise to source this stuff is small. So if you're the source of your token demand, and you as an investor know that you don't have to pitch this to anybody else because that project is out there buying and burning its token every day, and you know they're going to execute, or you're confident they'll execute. That to me is the best of all worlds, because all you have to do is be right that they're going to generate that revenue, and then there's nothing else you have to worry about. There'll be market fluctuations without a doubt, but over time that should work. Again, that's the whole thesis here, and we're not yet at the scale where that's played out. But let's find a project with 10 million of revenue, 20 million of revenue, which by the way could happen end of this year or next year, and then I think we'll be seeing some powerful dynamics.
100%. I think GeoNet is probably the best in class example today. I'm glad you shouted them out in your report, because just look at the chart. Everything else is, all the other alts, I should say, not Bitcoin, but all the other alts really have been down only for the last, feels like 6 to 9 months. And GeoNet actually hit an all-time high during that period. So definitely think it says something about generating revenue and accruing a lot of that to your token and doing so publicly, on chain on a Zune dashboard. Yeah, Tom, this has been great. Anything else you want to cover real quick as we run into time here? Or do you think we covered most of the report, and what did you want to talk about?
I guess the only thing, I think I'd say is there's a couple of things I'd say. One is that this sector is still very small, and that I'm convinced that there's a huge amount of opportunity in a variety of these subsectors within DePIN, whether it's storage, whether it's, talk to was it AYO that actually has a superior, more secure storage service than what you get on the cloud, right? So it's not just lower cost, it's not just retail, but there's real, institutional class services being offered here that I think will generate real traction, real revenue over time. And so I'm super excited about that. And I think we're, a little way, we're early in it, but that's coming. And then the other, that's the main point. The other thing I think is interesting is that we're really here because the convergence of hardware costs and also, it's hardware costs and also sort of open source technology availability and crypto economics. Like those three things have converged to bring us DePIN. So DePIN couldn't have existed without each of those getting to the level it is now. And as hardware costs go down, as software, open source software, reliability and availability increases, and as crypto economics become more widely spread, it's only going to increase the viability and opportunity for this whole ecosystem.
Very well said. It's still early. And Tom, thanks very much for coming on. Thanks for the work you do in DePIN with your podcast and this great tokenomics report. And thanks for sharing what you've learned over the last few years with us here today.
Awesome. Thanks for having me on, Connor. Really appreciate it.